Hello and welcome back to Money Discourse. What have we got in store for you this week? Canada's shock interest rate hike decision. We've got China's economic woes. We've got Google and Microsoft earnings. We've got the inverted yield curve, which may slow down the Fed's hiking. A lot on the plate today. Rajan, why don't you take it away?
Yeah, I mean, it's been quite nice coming into this where we've actually had a bit of a rally. I mean, we've actually bounced roughly around 10% from the lows in the S&P, the NASDAQ, the Dow. But again, the NASDAQ has been the heaviest one, being filled with most of these tech names, which has received the brunt of the selling on the back of these higher rates. But we did see some signs on last Friday from the Fed, a Fed official from Wall Street Journal's Tim Ross, that was noting that the Fed is barreling towards a fourth straight 75 basis point rate rise in November. But that meeting could serve as a critical staging ground for future plans, including whether and how to step down to 50 basis points in December. So that gave the market a bit of an impetus to basically turn around, slow down a bit and rally, as it sort of shows that the Fed is thinking about tapering off the rate of their rate increases. And we've seen that sort of doubled up this time with Canada. So Canada was supposed to raise 75 basis points a day, but they actually raised 50 basis points, citing that, they're seeing a bit of a deterioration in the economic conditions, and that is right to slow down the pace, considering the pace that they've already been on. But they did know they are not stopping. They will continue, but the pace of rate hikes has slowed down, which I think has been beneficial to the market. And then today, you can see, we had a good day yesterday. We had a strong week last week. And today we're having a bit of a mixed session because obviously the NASDAQ is down because we've got Google and Microsoft both down 5 to 6% each, which is a huge weighting on the NASDAQ. Got Amazon, which is down because as a precursor to those two earnings, that's down in sympathy. Meta was down. They're reporting after the close today. So they're down, but they've come off the lows. And Apple's still pretty strong in there, but still it's down a little bit. So we've got the 4 to 5 largest components of the NASDAQ, which are all down, which is weighing that index down. But if you look at the broader market, the Russell is actually up. The Russell is currently is up. The E-minis is slightly lower, and the Dow is outperforming. The Dow is actually up around just under like 0.5% or something like that. So it's been it's a bit of a mixed bag this morning. So let's talk about Google. I mean, it sort of goes on from the back of Snapchat, shows that Snapchat wasn't just the only one that's suffering from these ad revenue declines. We actually saw with Google that YouTube actually was down year on year in terms of their revenue, I believe. I mean, again, coming back to, is this an Apple problem, or do you think this is a more macro problem?
Yeah, well, I think it's obviously a combination of both. When there's an economic hardship, this is the first type of budgets that get cut, or they try to eke out more performance from certain campaigns. So you try to get a bit more bang for your buck. You're not just kind of spending willy-nilly like certain campaigns. It's just, 10K here, 15K there, whatever it is, just, get our impressions out there, just increase brand awareness. And then instead of that, they kind of go to campaigns where it's all about, how many conversions are actually made. It doesn't have as much of a lead as it once had, and especially with TikTok, becoming a more dominant force in terms of like the very young and the youth using that as this kind of search engine to get news and things like that, and maybe Google not innovating as much. But to be honest, Google is just a juggernaut of a stock, and it obviously still makes massive margins.
So I mean, if we look at the actual report for Google, I mean, they actually reported $1.06, which was a miss. The revenue was a miss. They're talking about, this is what I was mentioning earlier, that their YouTube ad revenue was actually down year on year, 7.1 to 7.2 billion. The market definitely didn't like that. And their operating margin was down to 25% from 32%. That was also not ideal. The search revenue still showed growth, but overall, and the cloud, as you would expect, 6.9 billion. But the thing is that Google YouTube ad revenue, considering it's still probably, in my mind, it's probably one of the most popular things. Like, I'm on YouTube so much. We're doing this on YouTube. So it's just crazy to think that, it just really shows how much these companies must be dialing back a little bit to show a decline in growth year on year. And we're seeing Google right now is actually down at 96. It is trading pretty much at the session, just off about $1 off the session lows, but down about a good 6.5%, 7%. So it's really, really getting whacked.
Yeah. But if you look at Google, shows a bit of mismanagement of their capital, because they increased their headcount by 13,000 people in the past 3 months. So like that's 36,000 employees year over year, right? I mean, why would you be doing that?
And they're not getting the return on their employees.
Yeah,
And those employees ain't cheap.
Yeah, exactly.
Stock compensation, these are all very well paid people. It seems very confusing as to what are they producing that level of staff need to be hired.
It seemed like there was just momentum on from, I guess, last year, where it was so hard to hire engineers and quality talent, and they just kind of carried on without even thinking that they need to actually tighten up. And it seems like they should have been doing this months ago. If you look at like really lean companies like Tesla, they were cutting workforce in Q2, and these guys are now just talking about doing it in Q4. So it's like it just shows, I think they need to cut a decent amount of their staff, and they'll they can do the same exact thing. If you look at what Elon wants to do with Twitter, he wants to fire 75% of the workforce, because why do they need such a large workforce? I think 2,500 people is plenty for Twitter to carry on, because they're not dealing in any kind of physical goods. They just need good quality engineers to be able to work on their algorithms, and from there, then it's just all about the content moderation. And if they can create bots to actually be handling that, let's see how that goes. But yeah, again, now what about Microsoft? How do you think that went?
Yeah, so Microsoft, again, this was a bit of a mixed bag. It's still down quite a bit. So with Microsoft, they actually reported 235, which was a slight beat of expectations, and revenue was also a slight beat. Their margins went down slightly, and they had good growth in their cloud revenue of 35% and 42% on a constant currency basis. But apparently that did fall slightly short of expectations. They did show actually quite good growth across the board in their advertising, their LinkedIn, but where they said was their PC demand was where they, so their more personal computing showed 13.3 billion in revenue, which decreased slightly year on year. And so that is where they saw the slowdown. And that sort of coincides with what we heard in the pre-announcements from AMD and NVIDIA as well. They all cited lack of a slowdown in PC demand on the back of this slowing growth. So that has been relayed there from Microsoft as well. So it's pretty much known that you're going to see that, but they didn't like that. But what really set the stock lower was their guidance. Yeah. So in the second quarter, they guided revenue of 52.4 to 53.4 billion, which was well shy of the 55.5 billion in the expectations, and they did note they're going to have a 5% negative impact from FX. Yeah. So this was the major catalyst which pushed Microsoft substantially lower, and right now it's down about $16, or call it about 6%. It's off the lows, but still back in the 230s. It went to a low of 230.17, currently 234.84. So Microsoft, just another one showing, it's a bit of a, it's how it's going to all play out, because that's two of the big four, if you call the big four, Amazon, Apple, Google, Microsoft, that have sort of whiffed on earnings. So now we'll see Amazon, I think, and Apple is tomorrow. So that'll be interesting. But the good thing is that we've had these two earnings, monster down moves, 6%, 7% for both of them. But yet the overall market, I mean, the Russell's up 1.5% today, small cap. The S&P is only down because of those tech names, but the Dow is actually up. So it hasn't actually brought down the market as an overall entity. We've seen a lot of segments outperforming today, just basically tech and the NASDAQ, which is being weighed down clearly because they are such a large component of it. So, it's not having that same reaction as it normally might do. So I think, maybe that's a bit of a positive, where the market's looking at them more as of an individual secular type of thing rather than an overall market problem. Or it's just the market's already priced in a lot of this and these individual stocks are just getting hit. So it's a good.
Things to be positive about for both Google and Microsoft are their cloud offerings. I think Google had a 38% year-over-year growth, and Microsoft Azure had a 35% year-over-year growth. So it's that part of it is still growing like crazy. It doesn't seem to be letting up, and it really just depends on like what part of the business are you like most focused on.
We've had a lot of earnings. We've got a lot of earnings coming up, but I mean, let's just talk about the big elephant in the room. Well, what really absolutely wiped my ass on Monday is China. You know what? I remember saying at the beginning of this year that I thought cable would outperform. I thought China would outperform. I think relative play. And boy, how wrong was I? I mean, it's got to a point where the government is now, it has taken, there's so much risk premium being put on this government. And on Monday, we saw a huge sell-off. We saw many of the US listed ADRs down 10 to 15%. Alibaba was down like 12, 13%. Baidu, JD, just the list goes on, Pinduoduo, all of them. And this is as President Xi ridiculously secured his third term. And it's more about how it's sort of perceived as not being market friendly. He'll probably be more public friendly. And that is really, and especially US listed stocks, it's really put a paid to it. And the thing is that it seems that he's aligned himself with a lot of people that support his cause. And that's really, it's really just sort of spooked up the market a bit. And the thing is that I actually, I've been long a bit of Baba, a bit of Baidu, not as much as I normally, I was earlier in the year. Luckily, I remember just taking the hits on it, but I'm glad I did. But I think yesterday's move was a bit over the top because fundamentally nothing had really changed, but it was such a dramatic move on the fact that he's got his third term, which was expected. But I think it's just we all saw in that video where that guy was being taken out, the ex premier getting taken out of the arena, the way he was just strongmanned out, and it really flustered a lot of feathers and just led to an exodus of Chinese stocks. But there was an analyst note from, I think it was JP Morgan or was it Morgan Stanley, saying buy China. And I don't never listen to analyst notes, but it's a buy China on this unrelated dip relative to fundamentals. So I put a couple of trades, shorted some Baba puts and I sold some K-Wood put spreads. And basically 38 days out to expiry, in one day, premium dropped 60%. Fantastic trade. Like Baba, it went 58 to 69, like literally from yesterday's low. That's a 20% in one day on Baba. So those Chinese ones, those plays actually worked out to be great. It was a fantastic opportunity. But all it's really done is sort of cut my losses from earlier. But it was I'm just glad, I managed to jump in. But again, China is just, I mean, I was talking to this about it. Alibaba at one point yesterday was worth $165 billion, $165 billion, and they're doing yearly revenue this year of $135 billion, and they're trading at an PE ratio of about 9. Like Baidu trading at a PE ratio of 9. That's this year's earnings. Forget about next year where it even goes lower, providing those earnings hold. So it seems like incredibly cheap for a company like Alibaba to be trading at such a low multiple, trading at less than 1.2 times revenue. I mean, this was just purely on a valuation play, even though the Chinese government is doing everything they can to screw over Chinese stocks. I mean, I think it's got to that level personally where it's got to be a bit of value in there, on how much more further it can drop.
Yeah. I mean, I guess the main fears are, delisting and things like that. That could potentially happen. I don't think it's going to happen to these guys. Obviously, they seem to be cooperating with, the audit rules, but let's hope. So we have the 10-year Treasury, which on the 10-year 3-month has actually inverted. So this actually signals a recession is usually 6 to 9 months away. But, most people think that we're already in a recession, but, I think it's just something that the Fed now takes heed of, and along with Canada, kind of scaling back the interest rate hikes, and even the UK saying that they're going to do the same. Maybe the Fed might take a pause. And remember, the stock market normally bottoms way before like the economy and the real estate sector does. So who knows if we're at an actual bottom? I don't smell the fear like a couple of weeks ago, but you know what? The market just switches like that, because all it takes is a couple of comments from the Fed, and we saying that, we're going to do another 1% hikes or something like that, just to scare the market, and then we're in the same situation. But just maybe something to be a bit optimistic.
Yeah, we are data dependent right now, and I think there is some signs. You've seen some of these housing data provided by like Redfin and some of these other companies sort of signaling a slowdown. And we spoke about this before, how there's a lag on how that is portrayed in the CPI. But the thing is, we're seeing that, and the Fed rhetoric is softening ever so slightly, but data is still going to be the main driver. So we've got, we're now back end of October now. We'll wait until mid next month to get the next inflation read, the PPI, and we're going to see jobs numbers coming up next week as well. So the thing is that all of those will be really important points to see where the Fed actually goes. But I think a lot of Fed members have acknowledged, just as the Bank of Canada did today, that we're getting towards that neutral rate, which they're all striving to reach. And that's all the market wants to see. The market wants to see the slowdown in the pace of rate hikes. And as soon as they see that, we're starting to find a bottom. And I mean, the sharp rise in the S&P is quite strong. Again, we've seen this playbook before over the last few months. So, I mean, again, the strategy for me is just start, trim on all of these moves up, and then add them back on the way down. I mean, it's the only play at the moment which seems to work, because eventually, when we do get a rally, and are we going to get Santa Claus rally this year? We didn't get one last year. In fact, last year when everyone was looking for the Santa Claus rally, we got the opposite. But I mean, I could see it this year, to be honest, considering the way we've moved this year, the general pessimism that we've got. I can see it. I could see it. But again, it all depends on the numbers. Everything just depends on the numbers right now. So we'll see.
Let's just see what happens with Apple earnings. I think that's going to be something that could actually weigh heavy on the index, depending if the rumors of the slowdown in iPhone sales are true or not. Apple always keep their cards close to their chest.
Again, I'm saying this before, to that the amount of Apple Watches and stuff on these Prime Day sales and stuff that I've never the Apple Watch 8 was already being discounted like 1 week after it was out. You could get watches, you could get the watches for cheaper and stuff. But again, to be honest, like there's always going to be demand. Apple's a very strong ecosystem. It's
staple of a company.
Yeah, I mean the thing about Apple is not about really how many they sell, because a lot of people weren't too impressed by the upgrades this year, but they'll just get it next year. It's not like most of the people are just staying put with what they have. But again, that's going to be interesting. Amazon will be interesting. They've done 2 Prime Days. One thing that I will note is that in the Prime Day press releases that they came out with, they did not mention once how well they did. They diverted that by saying, especially in this previous one, the one before, actually, they did mention how they had a record number of third-party sales or something. But this one, it was all regarding the amount of people they helped in third-party sellers, showing more emphasis how they are helping them rather than their own products. And so there seems to be a much more emphasis on that. And I don't think this second Prime Day was really that big of a event. So, but anyway, we'll see. We'll find out tomorrow. After the close, though, we will get Facebook. And considering how we had Google and Snapchat both disappoint, it's likely that Facebook will disappoint too. But for that very reason, there is some move for optimism if it doesn't come out as bad as people fear. So let's just see if Meta, I keep on calling it Facebook, but Meta can regain their mojo. So we'll see. But
it was interesting also with GM looking like they're doing pretty well, but I noticed a few discrepancies. Some guys on Twitter taking a look through the financials, and they were talking about the year-on-year growth, which is it's a red flag that the North American revenue was up 5.9 billion quarter-over-quarter, but the actual dealer inventory was up 5.8 billion, right? So it's like now supply chain issues have actually decreased everywhere. We're really going to see what is the real deal with GM. Remember the difference between Tesla, a company like Tesla, who has a direct-to-consumer model, and GM and pretty much all other automakers, is that GM counts a sale as when it actually leaves their factories and goes to the dealership. That's counted as a sale already. It doesn't need to go to the consumer's hands. Whilst with Tesla, it's actually once it reaches the customer and they take delivery of it. So yeah, it'll be really interesting, because obviously GM has I think at last count that I saw, their average selling price was around $54,000 on their vehicles. And now, as you're seeing used cars, the used car index actually decrease. I think it's like around 15% or so. It's actually going to now bring down I think, the average selling price on these vehicles, because there's just so much easier to actually procure, and a lot more dealers are going to be fighting over business rather than before. It was kind of like a take it or leave it thing. So let's see. I think
we
Q4
actually
and
have
Q1.
Ford. Yeah, we got Ford after the close today, so
Yeah.
I will be looking out for that as well to see how that relates in terms of Ford as well, whether they have this inventory build up like GM have. So that will be very interesting. It's a very interesting point. I mean, but to be honest, you can see this. Talking about used car prices and inventory. I mean, the offers you're getting at like CarMax, We Buy Any Car, Carvana, they've all plummeted. Like the offer on my car from 3 months ago is down 20%, 20% in 3 months. You're seeing, you're definitely seeing a correction in these used car prices. And you've seen it also with some of the names like a CarMax that just reported. All of them have, been a bit disappointing. So you're definitely seeing it there. So I would definitely expect a lot more inventory everywhere, whether they can shift through it again. This is will be all very interesting. We'll be keeping an eye out for that Ford press release tonight to see how they're, if they're faring with a similar type of thing. We've got Meta. Like Meta right now is down 6% ahead of the earnings, literally trading at session lows. We've seen a bit of jitteriness just before the earnings. So,
a lot of the world use Meta's products. And they're an insanely profitable company. I think they just need to ditch this metaverse, which, I think a lot of investors. I think he needs to just ditch it because it really, like, instead of plowing all that money into something that investors don't have confidence in, the market's just telling Facebook you're going down the wrong path. And just like how Liz Truss was ousted by the markets, I think, obviously, if Facebook they're trading at such a low multiple right now. It's actually like commodity type multiples. For a company like that, it should be a lot higher. But until they make some kind of course correction, it seems like investors just are not confident in them. Even me, I'm just like, I'm not going to add anything, even though it's so insanely cheap at the moment. What do you think?
Yeah, no, exactly. I mean, the thing is that apparently, there's this murmurings from Facebook staff that this metaverse project is, everything just to keep Zuckerberg happy. He's so hell-bent. He's so deep into this. They've released a new Quest 3 or whatever, the latest one, which is going to cost $1,500. And again, is it going to be mainstream? I've actually got the Quest 2. It's a great product, 100%. But again, I just don't see it being mainstream. Yeah. It's just not going to be that global product that they already have, which they've got almost half the world's population using it, right? So the thing is, it's like with Google, they've got all these other bets on the side, but their bread and butter is their search, and that will always drive most of their revenue. And same with Facebook. And the thing is that it's this big bet that Zuckerberg has taken. And so we had a big shorts, Michael Burry. Well, he's saying that Facebook is in big trouble. Not surprising. But there's a lot of people that are really getting on to Mark Zuckerberg about his constant need to really push this through. So
I think it's just too early. Even if you think about 2-3 years out in the future, you can't imagine leaving your house without your phone, right? But you're not going to leave the house with a pair of glasses. It seems like all of the information that you could get in a metaverse thing, you could get on a phone anyway. Like in the form factor, the technology is just not there. Battery tech, it just isn't there for it to be a lightweight type of thing on your face. But anyway, the thing is, people at Facebook must know this. Again, this is what happens sometimes when you have these leaders who are in control. It's all about their vision. And the thing is, like Mark Zuckerberg, no matter what, like he's got his product pretty much everywhere in the world, and obviously he's made some great acquisitions in terms of WhatsApp and Instagram, and grown them into formidable beasts of products. But I guess with this one, it's we'll just have to see.
Brad Gershner from Altimeter Capital, he comes on the pod with the All In podcast. So he wrote a letter to the Meta board urging Zuckerberg to slash staff and cut costs, and for the firm to get its mojo back. So that was from Brad Gerstner. So so that's the one that I was trying to recall. But there's probably a lot of pressure on it, and again, it's cheap, and as soon as they can figure that out, I definitely think there's a good run up. I mean, Facebook from its high, that's down a good 60%, 65%. Yeah.
But something else that's not down so much is Intel spin-off of
Mobileye.
Mobileye, which is
IPO today.
Like 30% up.
It's probably priced correctly. This IPO probably would have priced at 21. Probably would have priced at $40 last year. That's the thing. So that's the difference with having something that is priced at a more attractive valuation rather than some of these sky-high valuations that they were getting last year.
So if you look at it, it's around like 27 right now, up 31.24%. Something about this just makes it look like a bit of a cash grab. It's a very, very hard product to get right, and it seems like no one's cracked the code just yet. And it looks like Tesla is still in the lead with this, but you can go anyway. I haven't seen much from Mobileye recently, so it just might mean like Intel just wants to get a bit of cash out. Obviously, they're not doing so well. What is Intel right now?
That's
God! Look at that. That is just
a true definition of a fallen angel.
Oh right 100%. Let's just do the 3-month chart on that. Oh my God! Remember when this
was the world's greatest slide? It's the world's greatest slide. Roller coaster.
I remember when it just used to hover around between 50 and 55 for ages, and then just look at that. Wow. Yeah, so they need something to help their balance sheet. So I guess that's why they're doing it.
We've seen the Nasdaq drop to a low. We've seen Google hitting new lows. Ahead of these earnings coming up. So let's just hope some of these companies can come up with something a bit more positive than Microsoft and Google did yesterday. And please like and subscribe if you liked what you heard today. Give us any suggestions if you want us to talk about anything in particular. But on that note, we will catch you on the next one.